Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 3. My name is Pam Chernoff. I'm the Curriculum Coordinator at the CEP Institute. Introducing this segment of the webinar, which is focused on accounting. This webinar is provided to assist in your exam preparation process. The Level 3 webinar is being conducted by Ruth Doyle, CEP, who is a Customer Support Manager at Certant and also a member of our Certification Council at the CEP Institute. So on Level 3, 23% of the test is accounting questions. You're not just responsible for the new things that have come into play at Level 3, you're also responsible for topics that you have learned about on earlier exams. Often you'll have questions that are a little more difficult iterations of what you would have seen on earlier exams. But on Level 3, the focus is on the advanced portions of those topics and their applications, in addition to some new things that have come into play at Level 3. Your test may have a little bit more than 23% accounting questions because we do have 7 experimental items on your exam. Those are items that are not scored, but that we're trying to gather statistics on. They're not marked, but they do explain why the balances that you see may be a little different than what we're saying in these slides. And on that note, Ruth, I will hand it off to you.
All right, thanks, Pam. So the first several slides we're going to cover will discuss valuation inputs and different types of valuation models, starting with volatility. So all option pricing models require one to estimate the expected volatility of the company's stock for the period that the options being valued are going to be outstanding. The expected volatility should be based on the historical volatility, but should also be adjusted if the historical data is not indicative of future expectations. So this estimate can have a significant impact on the option fair value. The higher the expected volatility assumption, the more valuable the option will be. While an analysis of historical volatility is usually the first step to determine the expected volatility, there are a number of factors that you want to consider. For example, the length of the historical period used to calculate historical volatility in relation to the term or expected term of the options, and any significant corporate or market events that occurred during the historical period that may have influenced volatility and are not likely to occur in the future, although your auditors probably won't let you exclude anything. The maturity and the structure of the company during the historical market conditions during the historical volatility period. If historical volatility is calculated over an extended period, it might be attractive to give more weight to the stock's volatility in more recent years, especially if volatility is lower in these years, since the company might feel that these years may be more reflective of future conditions for both the company and the market. Unfortunately, in SAB 107, the SEC discourages this practice. So companies that believe their long-term historical volatility is not indicative of their future volatility may be forced to find other support for adjusting this assumption. So on to implied volatility. So this is only available for companies with exchange-traded options. These are not the options you get in an award, but the ones that investors would buy and sell on an exchange. If options on the company's stock are actively traded, it may be illuminating to compute the stock's implied volatility using the values of the traded options. When the trading price of the option is known, along with the other inputs used to determine the value, the Black-Scholes model can then be applied to determine the volatility assumption. This is referred to as implied volatility, and it's considered to reflect how the stock is perceived in the marketplace. Implied volatility can in itself be very volatile, so companies might want to avoid relying on it too heavily. And where possible, SAB number 107 encourages companies to use both historical data and implied volatility to estimate expected volatility, but it does permit exclusive reliance on either if certain conditions have been met. When relying on implied volatility, companies should consider the trading volume in their stock and options. More actively traded securities are likely to be more relevant. It's also preferable to look to options that are traded as close to the grant date as possible and that have similar exercise price and remaining term. Tradable options often have much shorter terms than employee stock options, and SAB 107 suggests looking to traded options that have terms of 6 months or longer, and where the terms of the traded options are less than a year, not solely relying on implied volatility to estimate expected volatility. Generally, volatility should be estimated in a consistent manner from period to period. If you change this frequently, it would at a minimum need to be disclosed, and they could call previous fair value estimates into question. And when computing historical volatility, SAB 107 does permit the use of weekly or monthly price intervals, which sometimes produce a lower volatility than daily price intervals. However, that sufficient data points have to be available to rely on weekly or monthly price intervals. For example, the FASB staff indicates that monthly price intervals should not be used for historical periods of less than 3 years. Some companies will lack sufficient historical volatility data and also do not have quoted options that are capable of generating compliant implied volatility estimates. Companies that must resort to some type of peer or industry-based measure generally fall into one of 3 categories. You have private companies that lack historical or implied volatility data altogether because observable prices don't exist on their equity. Valuations are usually performed infrequently, further precluding even a simple or crude historical volatility calculation. Most private companies are left with no choice but to resort to some peer-based measure. Newly public companies. So companies that have been public for only a few years are in an especially difficult position. Rarely will they have a mature and liquid market in which quoted options on their stock will be trading, and their historical volatility suffers from even greater problems. The year after a company goes public is typically filled with intense volatility related to the IPO and the street's evaluation of the company as newly public. The following years may stabilize relative to the first year, but remain a highly evolutionary period to the company as it seeks to gain market share and efficiently invest its new capital. A steady state volatility rarely emerges during this time, and each year's volatility dramatically differs from the previous year. So it's difficult to forecast how quickly volatility will mellow, or even if it will. And then you have established companies. Not all established companies should use a historical volatility estimate. So companies that have undergone significant M&A activity, recovered from a Chapter 11 bankruptcy, et cetera, they would hardly derive a reliable volatility estimate from their recent historical experience. If implied volatility data is also lacking, a peer-based approach would be most appropriate for these companies. Even established companies should be critically evaluating the relevance of their historical volatility for the purpose of forecasting future volatility. So expected term is the next valuation assumption that we're going to talk through. And under the Black-Scholes model, the expected term of an option or SAR granted to an employee is the length of time the grant is expected to be outstanding. To the extent that it's available, companies may also want to consider industry data on exercise patterns, and SAB 107 specifically specifically permits the use of peer company data to estimate expected term. So while this data is not widely available as of this writing, it's expected to become available over the next few years. For companies that have insufficient historical data or that feel that historical exercise patterns are not reflective of current grants, for example, where the vesting, the expiration, or other terms of the newer grants differ materially from prior grants, SAB 107 permits those companies to assume the expected term is the average of the vesting period and the contractual term of the option. This is referred to as the simplified method. So for example, if an option is subject to 4-year cliff vesting and a contractual term of 10 years, the company would assume an expected term of 7 years. This formula can only be relied on for plain vanilla options, which the bulletin defines as service-based at-the-money options where on termination, the unvested shares are forfeited and the vested shares are exercisable for some short period of time. SAB number 110, issued on December 21st, 2007, stipulates that companies can only rely on this formula in the absence of sufficient exercise history. So for example, where the company lacks historical exercise data, or they have historical exercise data that has substantially changed the terms of its option grants so that that historical data is not relevant to the options that they're currently valuing. Or the company has historical exercise data but has experienced structural changes in its business that render that historical data irrelevant, again, to the options that they're currently valuing. SAB 110 further indicates that the SEC staff expects data on exercise patterns to eventually become widely available, and that once such data is available, the staff expects that this simplified formula will no longer be used. For stock options that are granted to non-employees, for valuation purposes, the expected term should be equal to the option's contractual terms. So in terms of the different types of valuation techniques available where you would be utilizing those valuation assumptions that we just talked about, Monte Carlo simulations is a third category of valuation techniques alongside a Black-Scholes model formula and also lattice models. We could have an entire discussion around the theoretical underpinnings of the Monte Carlo method, but instead this section we're going to describe the broad functionality of this valuation technique and its most common use in practice. The Monte Carlo method simulates future stock price movements as opposed to drawing a map or a tree of stock prices. If you can imagine the approach needed to simulate the probability of rolling heads in a coin flip. So it might involve testing the results by flipping the coin a few times. However, a few flips might yield a disproportionate number of tails, let's say, not because the probability of tails is higher, but because anything can happen in a few flips. A correct simulation would involve flipping the coin hundreds, if not thousands of times. This raises the most important point related to Monte Carlo simulation, which is that it is not really any different from a lattice model. A lattice model can be redeployed in a Monte Carlo environment to yield an identical result. The Monte Carlo is merely a different way of projecting future possible stock price movements for the purpose of assessing settlement behavior and terminal value at each of the expected settlement points. The Monte Carlo method is generally used to value awards with market conditions, conditions governing the time of the vesting and or the per share fair value or quantity of earnable instruments to absolute or relative stock price movements. Outside of the scope of this chapter, the requirement in AC 718 is to directly incorporate the effect of market condition into the valuation technique. This is generally impossible to do with a Black-Scholes model, and so either a lattice model or a Monte Carlo simulation would be required. One generally builds a Monte Carlo simulation not because the result is more accurate or even different, but because the features of a complex market award are generally more efficient to incorporate a Monte Carlo simulation than in a lattice model. So one common feature of a market award is the achievement window. So the market condition hurdle can be reached at any point in time, and when it's reached, it's maintained for some additional period of time, such as a 30-day period. This makes the award path dependent, which is far simpler to address in a Monte Carlo environment. The key point to note about Monte Carlo simulation is that it does not uproot or alter the core theory underpinning lattice model valuation methods. It's a different way of applying the same theory. Its use is concentrated in the area of market awards because their design is often incorporated into a Monte Carlo simulation with greater ease than with a lattice model. So later in the presentation, we'll talk about performance-based awards and how those would be valued, but really for market condition awards, Monte Carlo simulations are generally what a company would need to use. Okay, so some information about employee stock purchase plans. Under ASC 718, a company must calculate and recognize a compensation expense for its employee stock purchase plans over each purchase period unless the plan qualifies for a limited exception available for a non-compensatory plan. To be considered non-compensatory, it must meet all of the following requirements. So where the terms of the plan are more favorable than those available to all shareholders, any discount offered under the plan must be equal to or less than the company's cost of raising capital through a public offering. A safe harbor discount of 5% is allowed without further justification, but companies that wish to offer a higher discount must either offer that same discount to all shareholders or demonstrate that their cost of undergoing a public offering would be greater than that. The plan cannot incorporate any option-like features. So a common option-like feature that is prohibited under this requirement would be the look-back provision, under which the purchase price is based on the lower of the market value of the stock on the enrollment date or the purchase date. And substantially all employees must be permitted to participate in the plan on an equal basis. So plans meeting the rules for Section 423 ESPPs would generally qualify under this requirement. The fair value of the option granted under an employee stock purchase plan is comprised of 3 different components. So for all purchase plans, the fair value would include the discount provided under the plan as calculated on the enrollment date. For plans that include a look-back provision, the fair value also includes 85% of the value determined using the option pricing model of a call option granted with a price equal to the market value of the underlying stock on the enrollment date. So this component of the fair value represents the additional value that the employee will realize as a result of the look-back if the stock price were to increase during the purchase period. And the third component for purchase plans that don't limit the number of shares that employees can purchase if the price declines during the purchase period, the fair value would also include 15% of the fair value of a put option with a price equal to the market value of the underlying stock on the enrollment date, again, as determined using an option pricing model. So this third component represents the value of the additional shares that the employee would be able to purchase if the stock were to decline during the purchase period. So where a plan allows for multiple purchases during a single offering, each of those individual purchases is valued as a separate option. So for example, a 24-month offering that provides 4 different purchases to occur at 6-month intervals throughout the offering is treated as 4 options. So you have a 6-month option, a 12-month option, an 18-month option, and a 24-month option, and each would have a separate fair value computed for those separate components. The ESPP allow for a straight line or an accelerated accrual. Those are accepted recognition methods, and the expense is estimated based on the participant's contribution rates. So on the next slide, we have an example. So the same example with a 24-month offering period. So you have purchases that occur every 12 months. The price is 85% of the lower of the market value on the enrollment or the purchase date, so there is a look back. The market value on the enrollment date in this example is $10. The company estimates that the employees will contribute $850,000 per purchase period, and that would result in an estimated purchase of 100,000 shares per period based on that enrollment date price. So in this example, again, the plan is treated as the grant of 2 separate options. You have a 12-month option, you have a 24-month option. If we assume the fair value of the first option is $3.60, you get $360,000 in expense. The second option, the fair value, if we assume that to be $4.40, you would have $440,000 of expense. So you have a total expense for both periods of $800,000. And on the next slide, the manner in which you would accrue that expense or amortize expense, you can do it on an accelerated basis or on a straight line basis. So with straight line attribution, there's 2 ways that a company might choose to do this. You can record $360,000 of that expense in the first year and the full $440,000 of expense in the second year. So essentially each option is expensing over its own separate start and end date. Alternatively, the company might record $400,000 of the expense each year. So basically taking the $800,000 and just dividing it evenly over that 12-month period. If you were to use the accelerated attribution method, you're going to record the $580,000 of expense in the first year of the offering. So all of the expense for the first purchase period and half of the expense for the second purchase period. And then the remaining $220,000 would be expense in the second year of the offering. So both examples here assume that the actual forfeitures are exactly as anticipated by the company at the outset of the offering. But this is a pretty straightforward example of a very simple purchase plan structure, and both of these attribution methods would be acceptable under that. So on our next slide, we have some additional information about purchase plans. So in terms of truing up to the actual shares purchased, this would occur if an employee terminates from the company, or if there are changes to their salary because of bonus, salary changes, things like that, which would result in greater contributions than originally expected. If contributions are reduced, you are required to continue to expense the full value of that purchase period, and you would not true up to the actual shares that were purchased. And then if you increase the contributions during the purchase period, this would be considered modification accounting, and we're going to talk more about that later. But essentially, in terms of truing up to actual shares purchased, generally you're going to base your expense on the estimated shares unless one of these scenarios were to occur. And then our final ESPP slide. Certain relatively common plan provisions can trigger modification accounting when they're invoked. So these could include a provision that would automatically withdraw and re-enroll participants when the market value on the purchase date is less than it was on the enrollment date, and allowing participants to increase their contributions during an offering period. The occurrence of these events would be viewed as a cancellation of the original option and an immediate grant of a replacement option, and this would be accounted for as a modification. Right, so measurement date. So for measurement date to occur, a mutual understanding is presumed to exist on the date the board of directors or other entity with the appropriate authority approves the grant, provided that the following two conditions are met. So that the grant is unilateral and the employee does not have any ability to negotiate the terms and conditions of the arrangement, that the grant is expected to be communicated to the employee in a relatively short period of time, defined as the period in which a company could reasonably be expected to communicate the award under its customary practices. So this period could vary depending on the number of grants involved, the location of the grant recipients, whether they're domestic only, or if there are employees outside of the US, and also the method used to communicate the grants, whether it's paper, electronic, verbally, via manager, etc. Except in rare circumstances where employees might be expected to reject the grant. So, for example, employees outside of the US where they might be subject to a tax on the grant. Employee acceptance of the grant is not required to establish a grant date. Just the communication of the key terms and conditions would be sufficient. Where vesting is contingent on performance conditions, however, the grant date can't occur until the performance conditions have been established. So the employee and the employer can't have a mutual understanding of the key terms and conditions of the grant until that time. And where grants are contingent on additional approval, so such as shareholder approval, the grant date does not occur until that approval is obtained. So for example, if grants are contingent on shareholder approval of the plan under which they're issued or an allocation of additional shares to the plan, the grant date doesn't occur until the required shareholder approval is received. Compensation cost and measurement. So cash settled instruments. Liability treatment would apply to grants that the company can be required to settle in cash, either at the election of the employees or on the occurrence of events that would be outside the company's control. So liability treatment is required for cash settled SARs, and you can see Chapter 12 for more information on that, and for restricted stock units or phantom stock that are settled in cash. Where the grants can be settled in either cash or stock, liability treatment is required if the form of settlement is at the election of the employees. Where the form of settlement is at the company's election, liability treatment is required only if the company has established a pattern of settling in cash in the past. However, the threshold number of cash settlements that would be required to establish a pattern is generally interpreted to be very low. So where cash settlement is subject to a triggering event that's outside the control of the company, of the employee, the liability treatment would not be required unless the event triggering the cash settlement is probable of occurring. Also, where mandatory same-day sales are required for employees outside of the US, particularly those employees in jurisdictions where local law prohibits ownership of foreign securities, it may be problematic to demonstrate that employees are the legal owners of the exercised shares. So for these grants, the option would also receive liability treatment. In terms of compensation cost measurement, generally it will fall to the private company's board of directors to determine the fair value of a company's stock. If at the time of IPO, the SEC determines that these values were less than what it believes was the fair market value of the stock at that time, which is often the case, the company would have to recognize additional compensation expense for any options or awards that were granted during that time. For restricted stock, the additional expense would be equal to the difference between the value that was set by the board and the value determined by the SEC. So for stock options and stock appreciation rights, where the expense is based on the fair value, either because the right would be settled in stock or because the company has elected the fair value method for cash settlement rights, the expense would be the increase in fair value resulting from the SEC's determination of the stock's value. The additional expense that results from the SEC's determination of the stock's fair market value is often referred to as cheap stock expense. And some additional notes on modifications over the next couple of slides. Mergers and acquisitions are accounted for under ASC 805. The reason for this is that ASC 718 does not provide specific guidance in this area, other than to state that exchanges of grants pursuant to a business combination are accounted for as modifications. So ASC 805, the fair value of the grants before the conversion or exchange is determined on the consummation date of the acquisition. The fair value calculation should be based on the market value of the target company's stock and should reflect the impact of the acquisition. And for stock options, the fair value is computed using an option pricing model that considers the expected volatility and the expected dividend yield of the target company's stock, as well as the option's pre-conversion exercise price and its expected life. Because this calculation can be particularly challenging for stock options, companies have taken different approaches to estimate the expected life. Under the computed expected life method, the company divides the weighted average expected life for all options granted during the year by the total number of years in the contractual term and then multiplies the result by the remaining years in the contractual term. This method is normally used for valuing options for estate planning purposes. Once the new fair value has been determined, the portion attributable to past service is considered to be part of the purchase price of the acquisition, and the portion attributable to future service is recognized as compensation expense by the new entity. The full fair value of vested portions of any grants exchanged or converted during the acquisition is then considered part of the purchase price. And for the unvested portions of grants, a prorated allocation of the fair value is applied to determine what portion of the fair value would be treated as part of the purchase price and what portion would be treated as compensation expense. In the case of cancellations, so if you've got a cash settled grant that is modified, previously recognized expense would not be reversed, and this applies when option awards that under their original terms were to have been settled in stock are either settled or canceled in any situation other than a forfeiture. So if the award holder is not receiving a new equity award in exchange for the cancellation or settlement, any remaining unamortized expense would be recognized immediately in the period that the settlement or cancellation occurs. And if the awards are not fully vested at the time of the settlement or cancellation, the transaction would be viewed as effectively vesting the awards in full and triggering recognition of any remaining expense. If the award holder were to receive a cash payment in exchange for the cancellation or the settlement, the amount of the payment that would exceed the award's current fair value would be recorded as additional compensation expense in the period that the cancellation or the settlement occurs. And performance awards. So earlier we talked about market condition awards and the requirement of generally a Monte Carlo simulation or some other type of equivalent model. Let's take a look now at the attribution of expense for performance-based awards. So we are here talking about grants with performance conditions that are not related to the stock price. For options and awards that are subject to non-market performance conditions, the valuation would be computed without regard to those performance conditions, and the expense would be recognized only for the portion of the option award that actually vests. So companies would be required to estimate the likelihood of that performance condition being achieved and adjust the expense recorded for grants commensurately in each period. As those expectations to vesting change, the expense recorded to the grants would be adjusted. So ultimately, the expense that gets recorded would be trued up to the actual vesting outcome. If expense is being recognized based on an implicit service period, meaning during the period between grant and the expected achievement of the performance condition, any change to that expectation would affect the accounting for the grant. So if the change is that the condition is no longer expected to be achieved, the previously recognized expense would get reversed, and if the time to vesting were to get longer or shorter, those changes would get accounted for prospectively, meaning current period expense reflects the change in assumptions, but any previous periods would not be restated. You would do a true up in the current period, and then prospectively that change would be reflected in your future period expense. And finally, some points about EPS reporting that would come into play on level 3 of the exam. The first thing to know would affect grants that receive dividends on unvested awards, but only if the dividends are not subject to forfeiture if the grant never vests. So in this circumstance, the company is required to use what's called a two-class method when reporting earnings per share. This method is typically used by companies with multiple classes of common stock or with other securities that would participate in dividends paid to common stockholders. It uses a formula to allocate the earnings, the number of the EPS, the numerator of the EPS equation, to each security. So for these grants, separate EPS calculations are required. For the company's unvested awards, the calculation can't be combined with the calculation for the common stock of the company. And the second thing to note is how companies must handle grants that are outstanding for only part of the reporting period. Options and awards that were granted before the start of the reporting period and are still outstanding in full at the end of their period would be weighted at 100%, and all other grants are weighted at a lower percentage that would reflect the portion of the period that they were outstanding. So for example, a grant that was issued 1 month into a 3-month quarter would get a weighting of 67% for that report period for your diluted EPS calculations. And then finally, we have some notes in terms of the differences between ASC 718 and IFRS 2 and how they would calculate expense and some of those valuation requirements. So in IFRS 2, there is an expressed preference for lattice models, unlike ASC 718, which doesn't explicitly state a preference and allows use of a Black-Scholes model. IFRS 2 would want companies to use a lattice model. And it also requires more specific valuation assumptions, so expected life, your forfeiture rates, for example, different assumptions to employees in different countries. So they require that you get to a much more specific and detailed level than what is expressly stated in ASC 718. It also requires accelerated attribution methods, so you wouldn't have a choice between an accelerated method or a straight line method. It requires that forfeiture estimates be applied to expense accruals. So with recent changes here in the US, you can choose to estimate forfeitures or not. Under IFRS 2, you would have to do those forfeiture estimates. And then for tax accounting, there is different accounting for book tax benefits and actual tax benefits. It also requires liability treatment for shares that are used to cover tax withholding that would be in excess of the statutory minimum. It requires recording of payroll or social insurance tax obligations as a liability. And under IFRS 2, all ESPP plans would be considered compensatory. And that wraps up the specific slides. So Pam, I will hand it back to you.
Great.
For some closing remarks.
Thank you, Ruth. I really appreciate this. For candidates who are interested in additional courses that may help in your exam preparation, we've listed a couple options on this slide. We're not endorsing any of these programs, we're just giving this to you as information. This exam overview webinar is provided to assist you in your exam preparation, but in and of itself, it's not sufficient exam preparation. All of the questions you will see on the test are developed exclusively from the assigned materials, and you should study those materials thoroughly. And if you have questions about anything, refer to those materials, go back to the books. This webinar is available to you for unlimited viewing until the exam date, and the same is true of the webinars at the other exam level. So you've got the 4 webinars for this exam, as well as the 4 for level 2 and the 4 for level 1 that you can review as you are studying. And on that note, thank you again, Ruth, and good luck on the test, everybody.